So what is actually buying and selling a call like? In this video, I'm going to walk you through some live examples in the Thinkorswim platform. Hey, how's it going? On this channel, you'll learn the steps it takes to make a full-time income trading in the stock market. So if you're new here, consider subscribing. And today, we're doing some live examples of buying and selling calls in the Thinkorswim platform. So here we are in the Thinkorswim platform, and this is a 1-minute chart of Microsoft. So the ticker would be MSFT, and we're going to buy a call right now. Now, I wouldn't necessarily suggest this is a good spot to buy a call because it looks like we're kind of in a nasty downtrend, but we're going to do it anyway just as a good example. And it might be a good example of showing you how quickly you can also lose money with calls. Now, one thing to keep in mind with options is the leverage is pretty insane. You are basically buying 100 shares almost. And so to do that, for buying 100 shares on Microsoft, you would be having to put up over $11,000 or just about $11,000. And so just keep that in mind when you're buying a call. You're essentially buying a leverage for almost 11,000 shares. Now, it's not really black and white like that, but it still is a lot of leverage to keep in mind. So here is the options chain of Microsoft. And just to close this, here are all the different expiration dates we can do, all the way up to 680 days out calls. Now, these calls, as you can see, are a lot more expensive. Now, they're about $1,500 for at the money. And then if we go to the current or 1 day till expiration calls, they're only about $80. So these will be a lot cheaper, and we're gonna probably want to get about 60 to 80 delta calls. So right here, this is a 80 delta call, so that's pretty good deep in the money, and so we will buy that. So we can see right here it is trading for about 156, 160. And just so to buy this, we're just going to click buy and then buy single. And then that's going to bring up this tab down here. Now, this is going to just default at 10, and I'm just going to leave it at that, but you might want to change this to just 1 or maybe higher if you're trading more. And then we won't really need to change anything else. Now over here, you do have the good till cancel or day. So if we wanted to leave this buy order in for longer than just 1 day, you would want to change this till GTC or good till canceled. And then this is just going to try and get us filled at the natural or at the mid price. Now the mid price is usually what you want to go for. It's the more fair trade price, or you're kind of, if you were essentially bargaining for a good price on the call. The natural is you're just going for, I want to get in this right now, just take my money, I want the call. Now, usually you don't want to buy on the natural. It's way better to try and get filled on the mid price, and usually we'll get filled on the mid price. But just because this is a demonstration, I want to get filled right away, I'm going to just click on the natural here. And then so we click confirm and send, and that's just going to bring up another order confirmation dialog box. And so this trade is going to, because we're buying 10, it's going to be 160 times 10. So it's actually going to cost us about $1,700 for these 10 calls. So that's quite a bit of money, and it's going to tell us that it's going to cost that much in buying power, because when you're buying calls, all that matters is you just have to pay up front. It's like buying shares. If you lose, your max loss is how much you put up. That's pretty nice. So you know how much you can lose right away. So we're just going to click send, and up here it'll show us that we put that order in, and then it also got filled right away. So if we go back to the chart now, we probably bought about in this area, so we're probably not up money or down money yet. But as this goes up, we will start to make money, and then as it goes down, we will continue to lose money. Now, as time goes on, our option will also be decreasing in value because of that theta on our call. Now, the one thing that's annoying about Thinkorswim, we can't bring up our position value right on the chart. And so you actually have to go back to either the trade tab where we can see it down here. You can see we're already down $70 here. Or you can go to the monitor tab where you can see that as well. One thing you can do is either you could have multiple monitors. And so just to try and simulate that, I will just bring a chart of Microsoft up. And so we could watch the chart go down or up and then see the value of our position change. Now, one thing you can see is that this option has a ton of theta. Now it just jumped up even. And so this option will be losing quite a bit of value over the time that we hold it. So we wouldn't necessarily want to be holding this all day or even overnight if the market was just kind of going sideways, because there's so much theta on this option that as the market just either goes against us, we're losing money pretty quickly because this option is so close. And this is the main reason why you want to buy options that are further out in time, so you don't have to be worrying about that theta eating away at your profits. If we go here and let's just buy another call that is 8 days out, so next week's expiration. So this is a 80 delta call. We'll try and get an 80 delta call again. So these calls will cost us more money. So we can try and simulate as much as possible by having our position, let's say, in half. So it will cost roughly the same amount as our last position. So our last one costed about 1,700. This one is going to cost about 2,000. And so we'll just confirm and send. And then we can see that down here at the bottom, I'll just bring the chart up again. Down here, you can see that the theta, even though this position down here of the 5 calls is actually more expensive, it costed us about 2,000 compared to these 109 calls that expire tomorrow. Costed, I believe, about 1,700. Theta is a lot bigger on these calls, and so it won't eat away as much at our position. The calls that do expire tomorrow will have higher delta. You can see that they have about 800 delta. So every dollar that the stock does go up, we make $800 on those calls. And then of course, every dollar it goes down, we lose $800. And so we would be losing about 50% of our initial position if the stock went down $1. So that's pretty crazy, because this is a over $100 stock. And so $1 down isn't that big of a move. And so it's totally feasible that that happens in a day, or even just a few hours, or even a few minutes if the market's moving very quickly. So seeing as our positions aren't doing very well, we are going to now create a closing order for them. And so all I need to do is right click and then create closing order, and that'll bring up this sell order. Now I can try and get filled at the natural or the mid price again. Usually you'd want to try and get for the mid price, because again, this is dollars that I'm potentially losing. So if I get filled at the natural compared to the mid, that's $3. And then times my 10 contracts, I just lost $30 right there. And that might not seem that much when you're trading $4,000 on a position, but if you do that every time, that adds up pretty quickly. So I'm just going to go for the natural just because I want to get out of this position right away. Now, sometimes it is okay to get filled at the natural. And right here, I'm doing it just because I want to get out of the position right now. And so I'm just going to click confirm and send, and it's going to show me, again, just that little summary. And then I'm going to send that in, and I'm also going to quickly close out this one. Now, if we wanted to then short Microsoft, so because it looks like it's going down, why not let's sell a call? Now, so selling a call is actually just as easy as buying one, but usually you want to go on the other side. So if we wanted to sell a call, we would probably come into the at the money or out of the money. Now, because it is 1 day away, there's not really great calls that we can sell, but here we are going to sell this 110 call because it is just about at the money. So I can just right click on this again, and instead of going to buy, I'm going to do sell single. And then again, you can see I'm going to sell 10 of these, and it is going to be for $70 each. So that would be 700 because I'll be selling 10. Now, one thing about calls is it's just flipped when you're selling them. So instead of our max loss being $700, our max profit is $700, and our max loss is infinite. Because we don't know how much we're losing, you generally have to put up a certain amount of collateral or buying power in this case. And so you can see that the amount of buying power that this is going to take up is $22,000. And so selling calls is a lot harder than just buying them because we need a lot more money. So it's essentially when you're buying stock, like just buying shares, you need a ton of money to buy them. It's the same thing when you're selling calls, because when you're selling the call, you're selling the right for someone to buy those shares from you. So you might have to essentially buy those shares at your strike price, which here is 110. And so that would be a huge loss with the amount of shares we're about to potentially sell someone the control of. And so here we'll just click send. And then again, that'll sell right up here and show us that we got filled. And then down here, you can see that we have those positions that we looked at earlier. And I will just bring the chart up again. And we actually just missed a substantial little move to the downside. So hopefully this will come back up a little bit and then continue with this downtrend here. And we will see this position get filled. So I'll highlight it. These right here are our short calls, and those will gain value as we go down. Even though the strike price of those calls is actually down here, and someone could exercise them for a potential profit right now, because we are selling them with that taken into account, we sold them at a higher price. Even though that technically in the money calls right now, they were sold essentially when the stock was up here compared to down here. So the pricing of calls can be really confusing sometimes, but a lot of the time it's really easy to just kind of put it in stock terms. Is if we sell a call here, it's essentially like shorting shares. And so if it goes down, we will make money on that position. And then on the flip side, if we sold shares here and it goes up, we will lose money. And of course, that all depends on if you hold these till expiration. Now, that is when you're buying options, you can hold them till expiration and really not care about the value in between. But definitely when you're selling them, you always want to keep track of either the potential value they are right now if you want to just sell them back to the market, or if you're planning to hold it till expiration, being aware that you can get assigned at any time. In this case, that would be if the person that we sold these calls to decided to exercise their call option, and that would be buying the shares at $110. Now, it wouldn't make sense if they did it right now, but if the stock went all the way down to, let's just say 109, way below this chart, they could then exercise those calls. Most of the time, they will only be exercised on the last day of the option or even the last couple days. So even if the stock went all the way down to 105 and we had, let's say 5 or 6 or even 10 days left on our option, the option probably wouldn't get exercised until the last couple days, because most of the time people bought those options for a reason and they want to be able to give themselves as much time as possible for the stock to go in their favor. Generally, when you're selling calls, you're wanting to capture the theta because the theta is going to be in your favor. And so here we can see that our theta is positive. And so as time goes on and the stock sits here, we are actually making money. And so that is a huge draw into why people sell options, is because quite often the market will be choppy, and so we can just make money as the stock sits there. Now, it's a lot harder with more selling these in the money calls, but quite often you can sell pretty far out of the money options. So if we just take a quick look at the options chain again, you could have sold these out of the money calls here for $25 each. Now, it's really not that much money, especially on this small of a stock, but the strike price of this call is 111. And so if we look back at the chart, the likelihood of Microsoft going all the way back to 111 by either the end of the day, if that's when you wanted to sell it, or by tomorrow, would be definitely a stretch at this point. And so that is the idea of selling those out of the money calls is, well, I'm just going to bet that it's probably not going to come back up here over this time frame. And if it doesn't, well, I just get to take all that money. And it makes for some pretty sweet, easy profits when it works out. But again, because you're selling the option, you have to understand that if the stock went up to, let's just say some news came out and it went up to 115, you would be losing a lot of money. And so quite often, people actually, when they're doing this kind of stuff, they will do option spreads, because selling calls like this, it's actually called selling naked because your losses are infinite. Now, selling with a spread is something that's a little more protected, Now, if we just want to sell this, we will go to here and then right click create closing order, and we can do buy back. So because we actually sold these, you actually technically have to buy them back, but don't think that you're buying 10 calls here or how many you have. You are just neutralizing the calls, because think about it, you were negative 10 calls, so you need to go positive 10 calls to make 0. And so that is all we have to do here. And then because we're actually up money on this position, we will have made a little bit of profit on that trade. And so here we quickly got filled, and then we will be out with $90 profit on that trade for the day. Now, if you like the idea of selling calls, but you don't have $20,000 to be able to sell those calls by themselves, I will have a video out on spreads. Now, these allow you to sell calls with protection that take that need for that huge amount of buying power out of the equation. Now, if you like this video, I will also have one out on puts, so feel free to check that out. And if you just like this content in general, feel free to subscribe. And if you have any questions, don't hesitate to ask them in the comments below.